a webinar on the series of income tax. Today is the 11th session of our series, and speaker for the today's series is CMA Amit Shane. He is also a speaker for the entire series. I welcome our today's speaker CMA Amit Shane, sir. Amit, over to you.
Yes, thank you, sir. And I will straight away start my presentation. But before that, as you are aware that today's topic is taxation of individuals. So it is assumed or it is implied that we had individual headwise sections or sessions like salary, house property, capital gain, and all that. So I hope all of you have attended those sessions, and today's session will be a kind of summary of all those sessions because this will be a, you can say, combined presentation or combined discussion on the various topics. Uh, what I have done is, rather than going into the details of individual taxation, I have tried to cover some of the aspects of tax planning, and later on, I will be touching upon the concept of AI, that is annual information statement. Uh, these are some of the quotes like a fine is a tax for doing wrong, and a tax is a fine for doing well. And similarly, the hardest thing in the world to understand is the income tax. This is by Albert Einstein. As usual, the disclaimers like these are all my opinions and as it stands today. So this is for the assessment year 23-24. So of course, with the recent Finance Act, there are many changes in the act. So typically, these will be applicable effective 1st April 23. So those are not covered in the presentation. Uh, then these are some of the examples, or these are some of the aspects which I'll be covering. But my sincere request is don't advise anyone based on today's discussion, because there are certain other aspects also that you'll have to consider. Maybe at appropriate point, I will explain what I mean by this. And the disclaimer which I gave at the beginning, that is, it assume that you know the basic provisions of the act. Now, before we go into tax planning, tax evasion, and or other tax planning, we need to understand the difference between tax planning, tax evasion, and tax avoidance. So, tax planning is a systematic way of saving the tax, applying the various provisions of the act, like various exemptions, deductions, etc. And this is very much a legal way of saving the tax, right? Then, tax evasion is simply suppressing the income or inflating the expenses through manipulation. So when I say suppressing of income, that also means suppression of investment, suppression of facts, figures, everything. So this is a typical illegal way of avoiding the tax, or you can say this is totally a fraud, we can say. And in between these two concepts lies the tax avoidance. Now, tax planning and tax evasion is easy to understand, but when it comes to tax avoidance, basically, let's understand what it means. So, basically, tax avoidance means which lies in between tax planning and tax evasion. So, whenever any section is introduced in the act, or whenever any uh, amendment is made, there is some intention of the law, or there is some reason of amending that section, or you can say adding a new section. So that is called as spirit of the law, or you can say the intention of the law or the lawmakers. Now, of course, whenever the act is drafted, it is by human beings, and of course, because of that, there are quite a number of possibilities, or there are quite a number of interpretations of the same sentence by others. So tax avoidance is typically done in such a manner that there is no infringement of taxation law, and by taking full advantage of loopholes to attract the least incidence of tax. Now, those who are present in my business profession session, they will recollect that, or rather, not business profession, rather the set of carry forward session. In that, we had discussed one of these examples, wherein now there is a prohibition that you cannot set off business loss against your salary income, because many people started misusing this provision. And as I had explained that time, that suppose I am an engineer and I am working in a company, I am a salaried person. So I used to show that on a Saturday, Sunday, I am giving some consultancy to related to my field. And let's say the receipts are 2 lakh rupees, and against that I used to claim all the expenses like my depreciation on car, then maintenance, fuel expenses, mobile expenses, then depreciation on laptop, mobile, and all that. Let's say those expenses are to the tune of 10 lakh rupees. So 2 lakh rupees is income, 10 lakh rupees are the expenses. So 8 lakh rupees is the loss. And this loss I used to set off against my salary income. Now, till the time the section was amended, this was perfectly within the, you can say, boundaries of the law. But that was not the intention of this particular provision. So why this was used? This was mainly used because there is hardly any scope in the salary to do the tax planning. So this was one via media that people started using, and therefore the section was amended, and now the provision says that if you have got any business loss, then that cannot be set off against the salary income. So this was a perfect example of tax avoidance, right? So, tax planning, a legal way, tax evasion is totally illegal way, and tax avoidance lies in between these two. So, whenever you are doing tax planning or whenever you are advising tax planning, make sure that it falls under the tax planning and not under tax evasion or tax avoidance. Now, for this tax avoidance, there are two sets which are already been used. That is GAR, that is General Anti-Avoidance Rules, and SAR, that is Special Anti-Avoidance Rules, basically to uh, facilitate the lawmakers that if they feel that this is a tax avoidance case, then they can withdraw or they can cancel that exemption or cancel that tax, the way the tax has been calculated, and they can restore the original position. So these are the rights which are now given even in case of tax avoidance. So one has to be very careful. Now, will not spend much time on this, but as you are aware that whenever there is more than one interpretation of any provision, then one has to follow these rules of interpretation. That is, rule of literal construction, rule of reasonable construction, rule of harmonious construction, rule of beneficial construction, rule of exceptional construction, and rule of ejus dem generis. So we'll have to follow these rules of interpretation, and these are very critical when it comes to tax planning, because uh, we'll see some of the principles later on, but you'll have to keep in mind these rules of interpretation as well. Then key points related to tax planning. The first and foremost is the tax planning should not be done to defraud the revenue. So, as I said, tax evasion and tax planning, these are two distinct cases, but there is a very thin line between tax planning and tax avoidance. So, whenever you do any tax planning or whenever you advise any tax planning, the intention should not be to defraud the revenue or to save the tax in such a manner that it is not legal, or it is you can say the tax avoidance case. Then all the transactions in respect of tax planning should be correct, should be in correct form and substance. Then tax planning works within the ambit of the law and it is not illegal. Even the Supreme Court held in McDowell case way back in 1985 that the tax planning is legitimate. And whenever you do the tax planning, just keep this in mind, your other priorities and needs while doing the tax planning. And keep in mind principles of financial management. Now, last 2 points, maybe I'll quickly give the example. For example, you are aware that under Section 80C, if you invest say 1,50,000 rupees, then you get the deduction. Now, for doing this, let's say if you advise someone that you take a policy, life insurance policy, whose premium is say 1 lakh rupees per annum. Now, let's assume that person is a very young fellow. He had just joined the company or he had just started his career, and you are giving him or you have given them the advice that you every year or there will be an yearly premium of 1 lakh rupees and you take this policy. Now, the problem is, since he has just started his career, there could be some other commitments like family commitments, or maybe tomorrow if he wants to purchase a house property, then the moment he commits or the moment he commit himself for this 1 lakh rupees premium, this is kind of blocking of funds. So, whenever you are advising someone, you should also keep in mind that what you are advising and considering the age and maybe the future priorities of that particular person. Similarly, principles of financial management, again, we'll discuss in detail in later. But for example, let's say I'm not criticizing any particular investment, but just to give an example, say national pension scheme. Now, in national pension scheme, I'm talking about other than salaried people, that voluntarily you can contribute up to 50,000 rupees to save the tax. Now, typically, this young generation who nowadays have access to the stock market, and even if they are not from commerce background, still they know all these things, and for them, say NPS may not be a viable option. Instead, they may invest in say SIP or systematic withdrawal plan or maybe shares, and they may get the similar benefit what you are getting in NPS. So, on one hand, you got a tax saving. So you should also keep in mind what post-tax return that you are getting on a particular investment vis-a-vis if you do the investment otherwise, then what is the post-tax return that you are getting. So you should also keep in mind the financial management aspects whenever you are advising or whenever you are doing any tax planning. What are the objectives of tax planning? Of course, reduction of tax liability is the first and foremost objective. Then minimization of litigation. As I said, your tax planning should be correct in substance as well as in form. Then productive investment, healthy growth of economy, and economic stability.
Amit, your PPT is there?
Yes, I shared that PPT.
No, we are not able to view it. I thought.
Okay. Are you able to see now?
No, Amit.
Is it visible now?
I'm not able to see. Whether others are able to see the PPT?
No.
Okay.
Parke madam, can you please check whether any problem with the rights? Parke madam?
हॅलो
मॅडम तुम्ही बघू शकाल का राईट्स काय आहे का, कारण त्यांची पीपीटी ते शेअर करतात पण आपल्याला दिसत नाहीये.
ओके, एक मिनिट हा सर.
हाँ.
I think you'll have to assign me as a organizer. I think it is still showing as
You are
meeting
there
guest.
as the organizer. You have been
Sorry?
assigned already.
I don't know. When I see it, it shows meeting guest.
No, presenter. I can see you in presenter.
No, it is there in the presenter. Anyway, so maybe I'll
1 minute.
try to share it once
Let
again.
them check. Let them check.
Is it visible now?
No, not yet.
I think there is some problem because at my end also that message pops up for a second or so that the presentation is being shared and immediately it goes off. So I
Correct.
don't know.
Administrator is looking into this.
Okay.
Let's wait for 1 or 2 minutes.
Sure. Because I tried it with all the three options, that is Windows, entire screen.
Madam, can you able to check? Fadke madam?
सर आता ट्राय करून बघा ना.
Yes. Is it visible now?
No. Amit, can you do one thing? Can you please share the PPT to WRC, our admin?
Sure,
I
I'll
will
do that.
request them to please share. I don't know what is the problem this today.
Can you tell me the mail ID, please?
Just a minute. WIRC dot admin @ICMAI.in.
हॅलो.
बोला मॅडम.
हा अमित सर, एकदा ट्राय करून बघा ना परत. आता जरा थोडं सेटिंग चेंज केलंय परत.
Okay.
एकदा ट्राय करा ना.
Is it visible?
नो. मॅडम अमित सर तुम्हाला पाठवतील. तुमच्या इकडून शेअर करा. कदाचित तुमच्या इकडून होईल. आज काय इश्यू आहे माहिती नाही.
ओके सर. ओके.
WRC.admin@ICMAI.in.
Yes, I shared the same.
फडके मॅडम तुम्हाला मिळाली की सांगा फाईल. मेल मिळाला की.
हा मिळाली सर.
हा मग ओपन
मिळाली. वेळ ट्राय. हा आम्ही करतो.
मॅडम तुमचा स्क्रीन दिसतोय, तुम्ही पीपीटी चालू करा. ओके. अमित, which slide we have to go?
सॉरी सर.
कुठची स्लाइड नंबर?
नाही, पण मला दिसत नाही प्रेझेंटेशन.
मला नाही दिसत आता. आम्ही आता बघू शकतोय. आय कॅन एबल टू सी.
What about others? Are you able to see the screen?
Can you able to see? Yes. अमित एक काम करा ना, तुम्ही लॉग आउट
I
करून
will.
परत
I
लॉग
will
इन
just.
करा.
Yeah. Okay.
काय ते इश्यू असेल, लॉग आउट करा आणि परत लॉग. Amit, can you able to see? Amit, you are muted. Hello. Amit, can you hear me? Hello, Amit. Hello, Amit, can you hear me? Amit? Yes, now I think Amishan is sharing the screen. Amit, can you hear me? फडके मॅडम कॅन यू तुम्ही बघू शकतात का यांना अनम्यूट होत आहे का, कारण ते बोलतायत पण आपल्याला ऐकायला येत नाहीये. आता पीपीटी शेअर झाली आहे. फडके मॅडम.
एक सेकंड सर, एक सेकंड.
हा अमित आता बोलू शकता तुम्ही. हा तुम्ही अनम्यूट आहात. नाही तुमचा आवाज इकडे आम्हाला काहीच ऐकायला येत नाहीये.
Hello.
अमित नाउ वी कॅन हिअर यू.
Okay, good.
आता पीपीटी शेअर करा ना प्लीज.
हाँ. I hope
Yes.
now the PPT is
Yes,
visible.
yes. Now
Good.
everything is okay. You can start now.
Yes, thank you. Sorry for the technical trouble. Okay. So we'll quickly run through this slide now. So what are the golden rules for tax planning? So the first rule is spread the taxable income amongst the various members of your family. Then take full advantage of tax exemptions which are available. Take full advantage of permissible tax deductions, rebates, and reliefs. And the last golden rule is simple tax planning is smart tax planning. We'll be discussing this one by one, so I'll not go in detail. So typically, what are spread the taxable income amongst the various members of your family? So one is we have discussed this in income from other sources, that gift from one related person to another related person. There is no limit, so you can very much transfer the income by way of gift. Of course, if the transfer is, or rather the gift is to non-related person, there is a limit of 50,000 rupees per annum. So whenever you are gifting to someone, just make sure that he is the related party within the definition of income tax. So this we have already seen that transfer to your spouse or son's wife does not qualify for transfer to related person. Similarly, if you are transferring anything as a gift to your cousins, then also it is not allowed, because the definition of related person in income tax has to be followed. Then whenever you are gifting to someone, the recipient will not have any problem, because he can always say that I have received a gift from so and so person. But the transferor should have the proof of source. So suppose there is any query to the recipient and he submits that this has been transferred from Mr. X. So Mr. X should have the proof, valid proof of source of that particular gift. So it should not happen that you are gifting to someone out of your undisclosed income. So that care you'll have to take. Then, as I said, transfer to your spouse or son's wife is not within the definition of related person. हा मी आत्ता जॉईन केलंय परत. Sorry, there seems to be some technical problem today. I don't know why it is happening. Can somebody confirm till which slide I was
No,
audible?
you got disconnected from the first site only.
Okay. So from this slide?
No. Golden. This was the first slide.
Yes, these were the objectives. Okay. And then these are the golden rules. Anyways, I am discussing this one by one. So I'll start with the first point.
Yeah, from here. That was last slide. Yeah, from here you was.
Okay. So basically, two things. One is the concept of distributing the income amongst the various members of your family. The concept is divide and rule. So it's not dividing your family, but it is dividing your income. Then gift to family members, that is gift to related person, is exempt from tax. So again, you have to make it very clear what is the meaning of related person in income tax. So we have discussed this when we have discussed about income from other sources, that all your linear ascendants and linear descendants are covered in the definition of related persons, but your cousin's wife, son's wife is not covered under the definition of related person. So between your family members, you can gift any amount. There is no restriction, but any person other than your related person, there is a limit of 50,000 rupees. Then whosoever is transferring, then he should have the proof of, or you can say the source of amount that he is transferring. So let's say Mr. X has transferred to his son, say 50 lakh rupees. Then whenever son will get a notice from income tax department, he can always say that I have received it from my dad. So the income tax department will go to Mr. X and he will inquire that what is the source of this 50 lakh rupees. So one will have to keep in mind that it has to be from the disclosed income only. It should not be from the undisclosed income. So whenever you are transferring anything, just make sure that whatever transfers that you are doing is out of the disclosed income and not from the undisclosed income. Then, as I said, your spouse or son's wife does not fall under the definition of related person. So even if you are transferring anything to your spouse, that will attract the clubbing provisions, and in fact you will have to pay the tax on the that income. there is no tax on inheritance. So let's say if you are inheriting any property, unless and until that property is given on rent or you sell that property, till that point there will not be any tax as such. And the last point is regarding Hindu undivided family. So Hindu undivided family is a very good option for saving the tax, because the moment you form Hindu undivided family, it is a separate legal entity from income tax point of view. So practically whatever exemptions, deductions are available for individual, those are all available for HUF also, barring few exceptions. So if you form a Hindu undivided family, then up to 5 lakh rupees, there won't be any tax. So that is a good tool of tax planning. But of course, you have to keep in mind other rules and regulations, and plus typically the family conflicts, because whenever Hindu undivided family is there, then that common money, or that money comes to that common pool, and then if there are any disputes between the family, then settlement of, or you can say partial partition of HUF or complete partition of HUF can become an issue. But otherwise, barring these few things, Hindu undivided family is a very good option of saving the tax, because it's a separate legal entity from income tax point of view. Then the next is take full advantage of tax exemptions available. Agricultural income, section 10 subsection 1, as you are aware that agricultural income in India is exempt from tax. Of course, if you have agricultural income from outside India, that will be taxable in India. Then receipts from HUF, just now we discussed that HUF is a separate legal entity. So HUF has paid the taxes applicable on the income that it has. So whenever this income will be further distributed amongst the member, that will be exempt from tax. Similarly, in case of partial partition of asset, then it is also exempt from tax. Similarly, share from partnership firm, it is exempt from tax, but remuneration and interest on capital to partners is taxable in the hands of individual partners. Then gratuities, it is exempt up to 20 lakh rupees. Of course, there is a calculation involved in this. You must have studied this when income from salary was discussed. Similarly, pension commutation. So pension commutation is exempt from tax. Leave salary up to 3 lakh rupees is exempt. Voluntary retirement compensation up to 5 lakh rupees is exempt. Then life insurance money that you receive at the time of maturity is exempt under section 1010D. There are a few exceptions, but otherwise largely life insurance money which is received at the time of maturity or from tax. Then payment received from provident fund, again it is exempt. Then certain specified bonds, the interest is tax free. Scholarships and awards, similarly gallantry awards. Then there are certain specified businesses under section 35D, typically say 100% EOU and all that. So there you get the exemptions. Then capital gain on compulsory acquisition, then gift, amount received by way of gift, these are all exempt from tax. Then take full advantage of permissible tax deductions, rebates and reliefs. So rule number one is the aggregate amount of deduction under section 80C to 80U cannot exceed your gross total income. So you cannot have a negative income. So maximum amount of deduction under section 80C to 80U is your gross total income. Then these deductions are allowed only if the assessee has claimed those exemptions and valid proofs are submitted or made available to the assessing officer. So typically, in these cases, it is not automatic deduction, or it is not automatically you get the deduction under section 80C to 80U. So you have, firstly you have to claim this. And secondly, even if you have claimed, but if you don't have the valid proofs, then also this will not be allowed as deduction. Then these are some of the categories of deduction. Why these deductions under section 80C to 80 are given? First thing is to encourage saving. Secondly, for certain personal expenditure, for example, tuition fees, you get a deduction. Then for certain socially desirable activities, for example, donations under section 80G. So if you give the donation to any trust or any government agency like Prime Minister Relief Fund and all that, in that case also you get deductions. And four categories for physically disabled persons. So section 80DD, 80DDB, and 80U are for disabled persons. So we'll quickly see that chart. So 80C, 80 triple C, 80CCD, 80CCE, all put together, there is an overall limit of 1.5 lakhs, as you are aware. It includes mainly your provident fund, PPF, ELSS, that is equity linked savings scheme, mutual funds, life insurance premium, housing loan principal, stamp duty. So, in case of housing loan principal and stamp duty, again, one important point that you'll have to keep in mind that the wording is principal and stamp duty paid on house property. So many times, if you book an under construction property, still many persons claim the principal and stamp duty which is paid at the time of booking of that particular property, but which is not correct. You get the deduction only if it is a completed property. So if it is an under construction property, say first 2 years, if it is under construction, then whatever principal, stamp duty, charges and all that you have paid, that you cannot claim as deduction. And as far as interest is concerned, you can start claiming it only after you get the possession. Similarly, 80CCD contribution to National Pension Scheme, there is a voluntary contribution of 50,000 rupees that you can claim. And for salaried persons, up to 10% of the salary, you can claim as deduction. Mediclaim, 25,000 for you and your family. Additional 25,000 if parents are also included, and additional 30,000 if either of the parents are senior citizen. Then, in case your senior citizen parents are not covered under insurance, you can claim up to 50,000 rupees for the medical expenses. Then 80DD is for disabled dependent. Uh, so if you have any disabled dependent on you, then up from 50,000 rupees to 1 lakh rupees, depending upon the disability, you get the uh, deduction. So a certificate from a doctor is required in this case. Then 80DDB is for certain specified diseases. You get this exemption. So critical illnesses like heart related diseases, then cancer, brain related brain related diseases, you get a deduction. Again, depending upon the type of disease and the age of that patient, you get a deduction from 40,000 rupees to 80,000 rupees. 80E is for interest on education or education loan that you have taken. So practically there is no limit on how much interest that you can claim as deduction, but it starts with the year in which you actually start repaying the education loan. So typically, for example, let's say if you are pursuing MBA and that course is for 1 year. So typically for education loan, there will be a moratorium period for 1 year and your repayment will start after 1 year. So let's say from second year onwards, if you repay it for next say 5 years, then whatever actual interest that you pay during these 5 years, you can claim the deduction. Then uh, section 80EE is for those properties who are under affordable housing scheme, and the property value should be less than 50 lakhs and loan amount should be less than 35 lakhs. So in that case, maximum amount of deduction that you can claim is 50,000 rupees. Now, under section 24B, you can also claim the interest on the property. So the overall limit in that case will be 2 lakh under section 24B plus this 50,000 rupees under section 80EE. But the prerequisite is you should pay that much interest. So let's say if your interest amount is only 2 lakh rupees, then in that case you won't be able to claim 2 lakh rupees under section 24 and 50,000 under section 80EE. So the same deduction is not available. So typically if you are paying say 3 lakh rupees of interest, then or rather 2.5 lakh rupees of interest, then 2 lakh rupees you can claim it under section 24 and 50,000 rupees under section 80EE. 80EA, again similar to 80EE, this section has been introduced for affordable housing. Then EEB is for electric vehicle up to 1.5 lakh rupees. You can claim the interest deduction under section 80EEB. Then 80G is for donations. Then there is an overall limit of 10% of total income that much you can contribute towards donation, and depending upon the payment or to which agency you are making the payment, either 50% or 100% is allowed. So for example, if you are giving any donation to Prime Minister Relief Fund, then there is no cap as to how much you are paying as a donation, and whatever you are paying, 100% deduction is allowed. Then 80GG is for those persons who are either non-salaried or those who are salaried, but house rent allowance is not part of their salary structure. So they can claim deduction under section 80GG. So rent paid in excess of 10% of total income and subject to 25% or rupees 2,000, whichever is lower, you can claim it as exemption. Then 80TTA and 80TTB, interest on saving bank account up to 10,000 rupees, and in case of 80TTB for senior citizens, they can claim up to 20,000 rupees. Then 80U is for the assessee himself. We have seen section 80DD, that is if you have any disabled dependent on you, then you can claim the exemption under section 80DD. But if assessee himself is an handicapped person, then he can claim the exemption for the permanent disability. But there is a restriction that either you can claim 50,000 rupees or 1 lakh rupees. Again, depending upon disability, you can claim this. And the last point in this is reliefs under section 89. So typically for salaried people, especially those who are working in a government company or that is central government or state government, typically they get the arrears. So in that case, there is a specific calculation of relief that you have to understand, and accordingly you have to claim that relief under section 89. Similarly, for those who are having say retrospective salary change, for example, there are many companies. Let's say, for example, there is some wage settlement which is due, but it is not yet effective, and last 3 years it is still pending, and in the current year that wage settlement is finally done and you get the arrears for last 3 years. So in that case you can claim the relief under section 89. Similarly, if you have got a foreign income, then you can claim the relief under section 90 for the taxes that you have paid outside India. So international taxation is again one more topic for discussion. But just to give two important points regarding this, we have double taxation avoidance agreements with various countries, and typically there are two types of arrangements that we have. One is you get apple to apple exemption. So let's say if a particular income is taxable in say US, then it will be exempt in India. So that is one way of DTA. And second way is that income will be taxed in US as well as it will be taxed in India. But whatever taxes that you have paid in US, you get a credit for that in India, and that is nothing but the relief under Section 90. So if you have a foreign income and that country and India has a double taxation avoidance agreement, then you should check whether the relief under Section 90 is available or not. Of course, as I said, the prerequisite is you should have a DTA, and if there is a DTA, then see for that particular head of income, what is the applicable rule, whether there is an apple to apple exemption, or you can get a tax credit. So accordingly, the calculation will have to be done. Sorry, because of technical issue, I am going bit fast, but any doubt so far? Whatever we discussed so far?
You can unmute yourself and you can ask the doubt.
Or you can post it in the chat box also. Otherwise, maybe at the end we'll again see some questions and answers. But whatever we have discussed so far, if you have any doubts, you may please ask. Otherwise, I'll move forward. Okay, maybe we'll take it at the end. Then residential status is one more very good avenue for tax planning. So you should understand which all income is taxable and which all income is exempt. So there are two ways of reading this particular table. Firstly, Indian income is taxable in all the cases, whether you are resident and ordinary resident, resident but not ordinary resident, and non-resident. But foreign income is taxable only in the hands of resident, that is ROR and RNOR. Foreign income is not taxable in the hands of non-resident. Then, so proper calculation of residential status, and for that you'll have to preserve your copies of passport, wherein the migration and immigration stamping is done, and make sure that the stamping is done properly, because there are many cases wherein uh, the stamping is not done properly, the date is not clearly visible, and sometimes the stamping is done over and above the stamp which is already been affixed. So you'll have to be very careful and just make sure that whenever the stamping is done, it is correctly done. Otherwise, in future, there may be some problem. Uh, so your determination of residential status has to be substantiated by your copies of passport, visa, and related documents. So, and accordingly, you can charge uh, or whatever income that you generate, whether it is Indian income, foreign income, accordingly, it will be taxable. Then this we have already discussed family under family tax planning, that avoid clubbing of income of husband or wife. In that we have seen remuneration, then asset transferred without consideration, then gift to prospective spouse, and taking or giving loan transaction. This will not attract the clubbing provisions. We had discussed in detail under the topic clubbing of income. So I'll just skip this slide. Similarly, um, minor child, again avoid clubbing of income for minor child. Again, we had a detailed discussion, so I'll just skip this slide. Then the important topics of set off and carry forward of losses, inter source adjustment, inter head adjustment. This also we have seen it in detail, so I'll just skip this slide. Now, the second part of my presentation will talk about the tax planning under various heads of income. So when it comes to salary, then uh, firstly, there are many companies, typically the software companies, who will give you the option to choose your own salary structure. Or those who are practicing in income tax, if the client approaches to them that this is my total salary and this is the fixed salary which my employer has given, and the variable part we can have it as per our tax planning method or tax planning propositions. So in that case, you can study his entire income pattern, then other things, and accordingly you can structure his salary so that he will get the maximum advantage. As you are aware that government is in the process of simplifying the income tax, and that's the reason why 2 years back this old regime and new regime has been introduced, wherein under old regime you claim the benefits and you pay the lower tax rate, and in new regime you don't claim any expenditure, but you pay lower tax rate. So in this case there are many exemptions which were earlier available. Now either that is clubbed in standard deduction, or if you are under new regime, this most of the exemptions under salary you cannot claim. For example, I'm talking about assessment year 23-24. So you cannot claim the standard deduction. Similarly, you cannot avail the benefit of HRA and all that. So again, that is one more angle that you'll have to keep in mind, that which regime is beneficial for that particular SSC, new regime or old regime, and accordingly you should do the salary structure, or you should fix the salary structure. Then the concept of uncommuted pension and commuted pension. Uncommuted pension is always taxable. Commuted pension is exempt from tax. So, if you are doing a commutation, just keep this in mind, and accordingly, you should plan your pension income also. Then, pension received in India by non-resident is taxable. However, if it is received abroad and later on remitted to India, it is tax-free. Of course, this is in general, but again, as I said just few minutes back, that you should also see the double taxation avoidance agreement between the two countries, and accordingly you should decide whether that pension income will be exempt or it will be taxable. Then uh, the next point is provident fund and gratuity. So let's say if you are working in a company and if you withdraw the provident fund within 5 years, then the entire amount becomes taxable. So again, while leaving the company, also you'll have to keep in mind the implications of tax. Similarly, gratuity. Of course, in gratuity there won't be any case wherein you get the gratuity before completion of 5 years. So obviously you get it after 5 years and you will get the exemption. Then the next point for discussion is whenever it comes to deciding your salary structure, then you should decide between the rent-free residential accommodation versus house rent allowance. There are companies who provide the free residential accommodation to employees. So again, you should analyze that which option is more beneficial, more suited to the SSC to take the benefit of rent-free uh, residential accommodation, or to take the benefit of house rent allowance. Of course, this is applicable only where the free residential accommodation is provided by the employer. If he does not have any similar facility, then you don't have any choice but to go for the house rent allowance. Then uh, the next point is you should take complete exemption of HRA. There are many persons who feels that whatever rent that they pay, they will get the exemption under for HRA, but that is not true. Basically, there are three you can say rules for claiming the HRA. Number one is 40% of salary or 50% of salary if the accommodation is in Mumbai, Delhi, Kolkata, and Chennai, that is metro cities. Then the rent paid in excess of 10% of salary. So whatever rent that you are paying in excess of 10% of salary, that is only allowed. And third is HRA actually received. So again, you should have a clarity about how to calculate this HRA, and accordingly you should do the calculation and claim the exemption. Then uh, tax-free car for personal use. If you are a non-director and uh, if it is amenity in kind, then if your salary is less than 1.5 lakhs, nothing is taxable. But again, there are companies who give the free car facility vis-a-vis. There are some companies who provide the car allowance. So again, the choice between car allowance and free car should be judiciously evaluated, and accordingly you should uh, do the choice. Then valuation of car for official and personal use. Uh, Again, you should see the taxability of that. If it is used for fully for office use, then it is exempt from tax. But if it is for personal use, then the taxability will be there. So again, proper choice will have to be made. Then income under the head house property. Uh, this is basically the calculation of income from house property. From the gross annual value, you deduct the municipal taxes which are actually paid, then net annual value, then deduction under section 24, that is interest on borrowed capital. Then there is a standard deduction of 30% of NAV, and then interest on borrowed capital up to 2 lakh rupees and 30,000 rupees, and there is no limit for let out property. But also you'll have to keep in mind few of the things. First is there are certain properties whose income is exempt from tax. The firstly, income from farmhouse, then property used for own business or profession, and annual value of any one palace of any ex-ruler. Of course, third point may not be applicable for many of us, but first 2 points are something that we need to consider whenever we do the tax planning. Second is municipal taxes. It is available on paid basis. So just because you have received the bill, that does not mean that you will be able to claim the exemption. So unless and until it is paid, you will not be able to claim the exemption. So it may happen that in a year you have paid the municipal taxes for 3 years. So whatever you have actually paid, you will get the deduction irrespective of the year for which you are actually making the payment. Then whenever you are buying a property, especially the high value property, then you should buy it in the joint name, because the limit of 2 lakh rupees is for each person. So let's say you have purchased a property of 1 crore rupees, and if it is in the single name, then in that case, your wife, or let's say your spouse, will lose the benefit of 2 lakh rupees for interest as well as principal deduction. So, whenever you are planning to buy a property, then it should be in the joint name as far as possible, so that the interest can be divided. And suppose tomorrow, if it is rented out, then also the income will be divided between two persons, or wife and husband. Then there is a provision that uh, either you can claim the HRA exemption, or you can claim the benefit of self-occupied property. Now, there is an amendment by which it says that, so earlier the provision was, if both the properties are in the same town. So let's say you have your own property in, let's say, Pune, and you have a same property in Pune, which you have taken it on rent. Then you can either claim HRA, or you can claim the housing loan exemption. But now this provision is changed or amended, which says that if because of the employment, if you are so if you have a house property in Pune, but it is too far from your working place, so you have taken one more property on rent nearby to your working place, then in that case you can claim both HRA exemption as well as exemption for self occupied property. Then choice between self-occupied and let-out property, because for self-occupied property there is a limit of 2 lakh rupees, and for let-out property there is no limit. So if you have choice, of course, so that which one should be self-occupied and which one should be let out. So you will have to evaluate this from the income tax perspective as well. Then pre-construction period interest, many assessees, many persons, 1/5 of the pre-construction period interest is allowed from the year in which you get the actual possession. So let's say during the pre-construction period, you have paid 1 lakh rupees. So 20,000 rupees each, you will get it from the year in which the property is complete. Now, many times it so happens that the interest is claimed in the first year, and somehow second year onwards, the interest, this 1/5 portion is not claimed. So without fail, you'll have to keep in mind, and you'll have to claim this pre-construction period interest 1/5 portion. Of course, it goes into that overall limit of 2 lakh rupees. So this is not an additional deduction that you get. Then, if you are receiving a composite rent, that is rent from a property and rent from, say, furniture or plant and machinery, then you should see whether showing it as a composite rent is a beneficial thing, or splitting that into rent for property and rent for services or rent for plant and machinery is more beneficial, and accordingly you'll have to give the you have to make the choice. Then transfer without adequate consideration to your spouse or son's wife. Again, there are deeming provisions that if you are transferring the house property without adequate consideration, then that property becomes your deemed property, and on that you have to pay the taxes. And the last point is, this we have already discussed in when we had discussed about set off, that overall limit for setting off of loss is 2 lakh rupees. So earlier there was no such limit, but now with the amendment there is a limit. Then income from business and profession, there are three aspects which are important. One is the location of the business, second is the nature, and third is the constitution of the business. Location means if your unit is in SEZ, EOU, then industrially backward area, then there are certain exemptions which are available. Similarly, the nature, depending upon your nature of business, for example, there is a specific deduction for tea, coffee, and rubber development companies, site restoration fund, then prospecting for minerals, then for construction there is a section 44 AD. For professionals there is a section 44 ADA, where you can claim 50% as the profit on your receipts or on your gross sorry, on your net sale. Similarly, transportation, depending upon the number of trucks, your income will be assessed. And 44AE, in case of retail business, you can show up to 8% of your receipts as the profit, and you can claim the benefit. So these are all called as presumptive taxation. So again, you'll have to be very clear about which all businesses are eligible, and accordingly you should choose whether to go by the regular accounting and profit, or the second option is go for this presumptive taxation. So again, this is a very good avenue for tax planning, and more than tax planning, it is more hassle free, because the moment you go for this presumptive taxation, nobody is going to ask you for the expenses that you incur. So for example, typically all of us are professionals. So as a professional, if you are going for this 44 ADA, wherein you claim 50% as your profit, then income tax is going to ask you only about the receipts that you are having. So apart from that, whatever expenses that you are claiming, income tax cannot ask you any question, because that is the basic purpose of presumptive taxation. So that you'll have to keep in mind. Similarly, constitution also plays many times a vital role in the tax planning, because there are certain exemptions, deductions which are available for a particular constitution of business. For example, proprietorship and HUF. So again, in income tax, there is no concept called as proprietorship, but proprietorship means that individual person. Then partnership. In partnership, the unique thing is you can give benefit of remuneration to the partners depending upon your profit. Then there are certain exemptions which are available only for the companies. So again, whenever you start any business, you should consider that what all investments that you are making going to make in this particular company, and finally what is going to be your business model. So accordingly you'll have to choose the constitution, or you'll have to advise the constitution, because lot many things depends on that. Then these are typically the decisions which will have impact on your overall taxes. That is investment in depreciable asset. As you are aware, in income tax there are only two categories. One is more than 180 days and less than 180 days. So if the asset is put to use, this is of course for the first year. If the asset is put to use for less than 180 days, then you can claim only 50% of the depreciation. But if you are having that asset for more than 180 days, you can claim full 100% depreciation. So typically, this will be more relevant in the month of September and October, wherein if you are planning to buy a new asset, and if you are planning to buy it on say 15th of October, so rather than that, you should buy it before September, so that in the first year itself you can claim the full depreciation under income tax. Otherwise, you will be allowed to take only 50% of the depreciation. So date of acquisition is also important, particularly when it comes to these 180 days and all that. Then whether to lease a particular asset or to purchase the asset, again, as a cost accountant, we are all expert in this to do the capital budgeting and of course the taxation impact of this. Then whether to lease or buy, then whether to buy it from own funds or from borrowed funds, make or buy. So all these decisions, of course, uh, we are doing it in marginal costing analysis. So while doing that, you should also keep in mind the taxation impact of this. Similarly, the optimum capital structure to maximize the shareholders' wealth also will have to keep in mind. Then, typically, mergers, acquisitions, amalgamations, these are also very good avenues for tax saving, because we had discussed this in case of set off carry forward of losses, that if you take over a company who is having say accumulated losses or say unabsorbed depreciation, then from taxation point of view, you will be able to take the set off of those income, or not income, or those losses, and eventually you end up saving the taxes. Then just keep this in mind, the general and specific deductions, that is loss due to destruction of capital asset and all that, and avail the various tax advantage. We are going to discuss the Startup India advantage. Now, by that many people have, that they feel that if I start the business today, then I am eligible to get the benefits under this Startup India, but that is not the case. uh, Startup India, there are certain criterias, and those criterias have to be fulfilled, and then only you will be able to claim the exemption for Startup India. Then and one more misconception is people feel that it should be a new business. So if I'm starting it today, then only I will get the exemption. It is not the case. The definition says that period of existence and operation should not be exceeding 10 years from the date of incorporation. So there is a limit of 10 years within which you can claim the status of Startup India. Then annual turnover should not exceed 100 crore rupees. That is one more criteria. Then it has to be incorporated as a private limited company or a registered partnership firm or a limited liability partnership. See, just few minutes back, I was discussing about the constitution of a business, and what should be your appropriate constitution will depend upon what all benefits that you want to derive under income tax act. So let's say if you want to take the benefit of Startup India, then the minimum that you should have is the registered partnership firm or LLP or a private limited company. Now, in this case, if you are having a proprietorship, then obviously you will not get any benefit under this Startup India. So that you'll have to keep in mind. Then um, it's not that you just start any company and you'll get the benefit. Your product or service has to be a unique concept. So you should have work towards development or improvement of a product, process or service, and or have scalable business model with high potential for creation of wealth and employment. So there is a separate department under government which takes care of this Startup India related applications. So once you get the approval from that department, then only you will get the status of Startup India. And it should be a new venture and not formed by splitting up of revamping of earlier enterprise. So let's say there is one existing company and they have just hired off one of their divisions and they have started a new company. So that is not allowed. So it has to be a new company which is formed. Then what are the exemptions? 100% of exemption of tax excluding the minimum alternate tax on earnings for first 3 years under Section 80 IAC. If MAT is applicable, then you will have to pay the MAT. Otherwise, if only income tax is there, then you get a exemption for 3 years. Then, as I said, you should get a registration under Department of Industrial Policy and Promotion, and uh, it has to be the product which pushes for innovation and development of new product or service related to intellectual property. And then companies raise capital through sharing stock, and the profit earned by engaging in such dealings is known as capital gain and thus are eligible to be taxed. Startups receive an exemption of 20% of their capital gain, resulting in them having to pay less tax on profit earned through the sale of stocks and bonds and shares. So basically, just to summarize all these benefits, you will get the benefit provided you get a registration with DIPP and their approval. Then under capital gain, there are certain ways of saving the tax, but for that you should have a clarity about the period of holding, from where your period of holding starts, and accordingly it will be decided whether it is short term or long term. Then in certain cases, cost to the previous owner becomes your cost of acquisition, so you should be aware about those things. And full value of consideration for special transactions, you must have studied it when on that in the topic of capital gain. So these three concepts are really very important as far as the capital gain is concerned. I'll repeat: period of holding, cost to the previous owner, and full value of consideration. Then period of holding will decide whether it is short term and long term. So again, for different class of assets, the period of holding or to decide whether it is short term or long term will be decided. So again, you should have the clarity on those concepts, that uh, typically 12 months, 24 months, and 36 months. These are the three periods, and accordingly, it will be decided whether it is a short term asset or long term asset. For building or property, they have reduced the period of holding from 36 months to 24 months. So again, those who are planning to sell their uh, flat or bungalow, then they should keep this in mind, that now the period has been reduced from 36 months to 24 months. Then take the benefit of indexation and postpone the decision wherever possible. Typically, this is in the month of say March, that let's say uh, if you want to sell a property in the month of March, so you should as well think of selling it in the month of April, so that you will get one more year for claiming the indexation, because as you are aware that every year the index is declared by the government, which is typically 75% of the inflation rate, wholesale index inflation rate in India. So basically, particularly in case of month of March, if you want to sell a property, then you can postpone the decision to April. it has got two advantages. One is you get the indexation benefit, and plus to invest the property also you get one more year. So that is one advantage which you have. Then there are certain exemptions under section 54 and subsections thereof. So it depends upon whether it is short-term capital asset or long-term capital asset. Secondly, which asset you are selling, and of course which asset you should buy. So depending upon these three things, there are various exemptions. So again, you should be aware about those exemptions under section 54. Then particularly for shares, you should keep in mind the grandfathering clause, that is the rates which are there as on 31st January 2018. So either you can claim the actual cost of acquisition or fair market value as on 31st January 2018, and accordingly you can claim the, or you can calculate the capital gain. Other aspects, filing your return in time, otherwise there are certain losses which you cannot be carried forward. Then adhere to the advanced tax provision. So if your tax, that is after deducting your TDS and everything, is more than 10,000 rupees, then in that case the advanced tax provision becomes applicable. So if you don't comply with the advanced tax provisions, then there are interest provisions that you'll have to suffer. So make sure that you or your assessee, whosoever is having advanced tax more than 10,000 rupees, you should comply with the provisions. So there are four installments: 15th June, 15th September, 15th December, and 15th of March. So it has to be on an estimated basis, and accordingly you should pay the installments applicable. For senior citizens who are not having any business income, the advanced tax provisions are not applicable. So again, from a financial management point of view, if you are having a senior citizen client, so don't pay the advance tax if he does not have the business income, because unnecessarily we will be locking up his funds for the full year. So instead, at the time of filing of return itself, you can pay the tax, and there will not be any interest implications. But again, you should have a clarity. Then 234 ABC, these are the three interests which are applicable in case you don't comply with the advance tax provisions. 234A is for late filing of return. So from the 1st April till the date of filing, whatever number of months are there, accordingly this 234A, for all this 234 ABC, the rate of interest is 1.5% per month. So even if there is a delay by one day, the entire month's interest will be applicable. So 234A is for late filing of return, 234B is for short payment or non-payment of advance tax, and 234C is for non or short payment of deferred advance tax. So as I mentioned, 15th June, 15th September, 15th December, and 15th of March. So if there is any delay in, if there is any short payment or shortfall in the payment, or there is a delay in payment, then 234C will be applicable. Then uh, penalties for non-filing or non or short disclosure of income. As you are aware that for late filing also there are late fees up to 5,000 or 10,000 in some cases, and in case of not disclosing the income correctly or short disclosing the income, the penalties can be as high as 100%, 200%, or 300%, depending upon the uh, the nature of default. So this is a discretion which is given to the assessing officer, that he can charge up to 100, 200, or 300%, 300% penalty. So let's say your tax liability is say 5 lakh rupees. So the penalty can be 5 lakh, 10 lakh, or 15 lakh. So again, you should be very clear about this concept. Uh, then many times this amnesty schemes are declared by the government, or voluntary disclosure of income scheme which are declared. So again, you should take advantage of those schemes, and if there are any pending litigations, Then typically there are schemes which are declared wherein you can simply pay certain additional amount, and you can close that open point. So uh, again, you should keep in mind all this amnesty scheme. You should keep a watch on government announcements. Then the last point of discussion is about the annual information statement. Uh, Now let's quickly go through the background of AIS. Um, as you are aware that KYC, that is Know Your Customer, was made mandatory by RBI with effect from 25th June, sorry, 25th June, sorry, 25th April 2016, and it was updated till 10th May 2021. So under this KYC, you are supposed to submit your KYC document, that is your PAN and Aadhaar, with the central registry, and these KYC documents are mandatory whenever you are uh, opening an account, you are making a deposit, whenever you are withdrawing the deposit. So any types of transaction, this is mandatory. Now with this, what government or income tax department started doing was, everything was linked to your PAN as well as Aadhaar. So earlier there were many transactions which are typically called as Benami transactions or fake transactions, but since these were not linked with a particular PAN, it was very difficult to trace those transactions. So now with this KYC in place, every account is practically linked with a particular person, right? So that was the first stage. Then under this KYC, suspicious transactions were reported by the banks to the income tax department. So let's say in your account there are certain deposits or certain withdrawals or some unreasonable transactions which are happening. So all these reports used to go to income tax department from a bank, and which is so this is about the suspicious transactions reporting. Similarly, there is Money Laundering Act 2002. So if there are any defaults under Money Laundering Act or Foreign Exchange Management Act or the FATCA, that is Foreign Account Tax Compliance Act, which is of United States, but in India also it is applicable, particularly when you are dealing with US. So all this was started. Then the stage two of this was 26 AS. So you may be aware that 26 AS is a statement wherein you get to know about the various transactions, particularly the tax deducted at source transactions. So there are total 8 parts to this. Part A, your details related to TDS you can find. So whosoever has deducted your TDS will be able to see it in part A. Then part A1 is whatever 15G or 15H forms that you have filled in, that information appears in part A1. So let's say uh, if your income is below taxable limit, and for that you have filed this 15G or 15H form, then those details will appear over here, part A1. Then part A2 is when you are selling an immovable property, or let's say TDS on the rent of the property, those will appear over in part A2. Then part B is about the tax collected at source. So wherever TCS is applicable, then those information or those entries will be under part B. Then part C is about the taxes paid other than TDS and TCS. So if you have paid any advance tax, self-assessment tax, so that will appear in this part C. Then part D is about the refund that you get. So for any year, if you have paid excess amount, then you get a refund from the income tax department. And if the issuance of refund is delayed beyond 6 months, then you also get the interest. So refund plus interest is what is reported in part D. Then part E is specified financial transactions. Now these are all appearing in your annual information statement, which we'll discuss slightly later. Then part F is related to, sorry, part A is related, part F is related to sale of immovable property. Part G, if you are a businessman and if there are any defaults under for TDS, that is non-payment or short payment of TDS, then or late filing of return and all that. So all those will appear in part G, and part H is turnover as per GSTR 3B. So all this information was linked up, and this is shown in uh, basically your 26 days. Now, AIS, so typical transactions which used to get reported under 26 AS is if the credit card bills are paid in cash, the limit is of 1 lakh rupees. So over and above that, if you are paying, uh, then it used to get reported. Then if you are making a fixed deposit of 10 lakhs or more, so the limit of 10 lakhs is for fixed deposit, then credit card bills, then bond shares, then if you buy a foreign exchange, mutual funds, then bank draft, then deposit of cash in saving bank account. So for all this, the limit is of 10 lakh rupees, and 30 lakh rupees or more if you are dealing in real estate. So all these transactions used to get reported under this 26 days. So now there is third stage, that is annual information statement. So basically it provides comprehensive tax information of the taxpayer. So wherever your PAN is linked. So in 26 days, as you have seen in the previous slide, that there was a limit of transactions. So in AIS, there is practically no limit. Whatever transaction is linked with your PAN, all those will get reported under this particular AIS, right? So this is a comprehensive tax information to the taxpayer. Then the purpose is to promote voluntary compliance and enable seamless pre-filling of returns. So this AIS will be displayed, and if you accept all the information, then that entire information will flow in your pre-filled return, and you can just keep on pressing the buttons and your return will be filed. Then this was notified on 28th of May 2020, and 26 AS was also amended with this. Now, how it is different from 26 AS? 26 AS was mainly had information about the TDS, TCS, or maybe whatever taxes that you have paid. AIS is more comprehensive. That is, even your saving bank interest and non-TDS bank interest. So, let's say there are typically two interests that you get. One on which the TDS gets deducted, and second on which the TDS don't get deducted. And plus, you have your saving bank interest, which is on which the TDS is not applicable, but even those transactions will get reflected in AIS. So in 26 AS, mainly it is related to spending, but that is if you purchase some securities, then only it will get reflected. AIS, even the sale will get reflected. Then uh, one more important aspect in AIS is taxpayer can provide the feedback of the information which is there in the AIS. So whether the information is correct, whether the information is not correct, then if it relates to some other PAN or if it relates to some other year, that also you can report there. If it is a duplicate information which is appearing in AIS, then also you can report, and there is a provision for the customized feedback also. Then AIS, once you file the reply, it will show that what was the reported value and what is the modified value. and it gives the complete log of activities, that when you have downloaded, when the AIs got updated and all that. But so part A displays the general information pertaining to the taxpayer, that is your PAN, then Aadhaar number, name, date of birth, and all that. And part B has four parts. B1 is TDS, which is similar to 26S. B2 is specified financial transactions. B3 related to payment of tax, that is self-assessment tax, advance tax, and all that. And B4 is demands and refunds. Then part B7 is about the information. Then reported values are the ones which are reported in the 26AS, in AIS. Then modified values are, if you are not agreeing to any values, then you can make a reply to that, and accordingly this will get updated in AIS also. Finally, the process value means after duplication, if there are any duplication of information, then on the basis of predefined rules, this duplicate information will be clubbed together, and that is called as process value. And derived value means uh, uh, whatever information or feedback which is given by the taxpayer, considering that if there are any revisions in the value, those are called as derived values. And information category, that is the broad definition which combines similar information so as to present a simplified summary to enable pre-filling of income tax return. As I said, if you accept all the entries, the pre-filling of return or the filing of return becomes very easy. Then this is not very relevant, so I'll just keep this level 1, level 2, level 3 information. uh, this is a procedure to download AIS. Once you log into your income tax portal, click on the annual information services tab, then click on proceed. So there are 3 options. One is in PDF, one is in JSON file that you can import, download, and password for this is the date of birth, PAN in capital letters and date of birth in DDMM YYYY format. Okay. If the file is too big, you can request for downloading, and later on you can uh, upload. Then what are the salient features? It includes practically all the information as I explained earlier. So we'll now move to the practical aspects of AIs. What are the issues or problems? First thing is if the wrong PAN is uploaded in the system. So, for example, let's say if the bank, while entering the PAN, it wrongly enters some different PAN, or for that matter, anyone who is entering your PAN enters the PAN wrongly, or let's say he updates PAN for Mr. A, and instead of Mr. A's PAN, he updates to Mr. B. So there is a possibility that you may get the information which is not at all pertaining to you, and which is still appearing in the AIS. So of course, as I said, you have a provision to amend that. So you'll have to be very careful. So before filing your return, you should go through the AIS, make those corrections required, and then only file the return. Otherwise, it is deemed that you have accepted the AIS, and basis that there are many SSEs who have received the notices now. Then, if you have a joint bank account, then in many cases, it so happens that the same information gets reflected in both the PAN or both the SSEs. Let's say husband and wife are having the joint account, so same information about saving interest and all that will appear in husband's PAN as well as in wife's PAN. Then joint fixed deposit. So again, that interest will be shown in both the AIs. So again, as I said, you have a drop down menu wherein you can state whether it pertains to you, whether it pertains to some other PAN and all that. So accordingly, you can make the uh, changes or amendments in the annual information statement. Then joint house property given on the end, again there could be some duplication. Investment in the name of minor, again uh, that in investment in case of minor, whosoever parents PAN you are giving, under his PAN this AIS will get updated. Then different method of accounting if you are following. So let's say uh, you are maintaining your books on cash basis, and whereas your client is maintaining the books on accrual basis. So always there will be a difference between TDS uh, and income. So there is a provision to defer the TDS according to your method of accounting. So that also you can do. Then mm, expenses reconciliation in case of TCS, because as you are aware, for companies it becomes quite a critical thing that if the TCS is deducted by your supplier, then in that case reconciliation of that TCS becomes a is a big task, uh, particularly for bigger companies. Then this AIS is a dynamic thing. So as and when it gets the information, it keeps on updated. So let's say if you see the AIS 1 month before, and if you see it today, then we'll see that there are a lot of changes in that. So again, before you file the return, it is always advisable that you reconcile all this information, and uh, then only you file the return. So coming back to the last slide, what are the advantages of tax planning and overall this thing? It helps in the reduction of tax liability. Then proper tax planning saves the taxpayer from the inconveniences caused by unnecessary litigations, and indirectly it leads to productive investment, and saving of earnings ultimately leads to healthy growth of the economy and stability of the economy. And yes, so that's it from my side. If you have any questions, I'll be happy to take that. Yes, anyone, any doubts?
I will request you to unmute yourself and you can ask the question.
Yes, any doubts? So the basic intention of today's session was to make you aware about, or you can say it was a summary of all the heads put together, and what are the avenues for tax planning, as well as this annual information statement, which is again going to be very critical. And it has got its own advantages also, because many times it so happens that you don't do it intentionally, but by mistake, if you skip to report any income, for example there is inoperative bank account and there is some saving interest which is there, so you simply ignore that. But with the help of AIS, now it is very much easy to collect the information, because it's a, I would say, ready compilation of the information of your income. So it is easy for the taxpayer as well as it is easy for the tax consultant, because many times, even if we repeatedly point it out, but many times SSC may not give the full information. So in that case, it is also a very good tool for the tax consultants, that they get the ready information about the income, and they can incorporate that in the return, or they can at least ask the SSC that this is what is being reported in the AIS, whether it pertains to you or not. Yes. Any doubts?
I think there are no doubts are there, so we can conclude our session.
Okay.
I would like to thank CMA Amit Shahane sir for his excellent presentation explaining various provisions under the Income Tax Act related to taxation of individuals' income. I would also like to thank our WRC staff and all the participants. Our next session on the income tax series will be on Friday from 5 p.m. onwards. Thank you very much. For the later, whatever the recorded webinar session will be available on our YouTube channel, WRC-ICAI CMA. I will request you to log into that and view the session. Thank you.
Okay. Thank you all.